I, Professor B.K. Jain, Dean, Bhyani Institute of Science and Management of Bhyani Group of Colleges, welcomes you in this video lecture series on the subject of Management of Financial Services of MBA 3rd Sem. Today's lecture is devoted to financial instruments of money market. In the series of these lectures, I would recall first of all that we discussed in the initial lectures that financial instrument is one of the important component of the Indian financial system. Other four components of the Indian financial system, as we discussed earlier, they are financial markets, financial services, financial intermediaries, and regulatory bodies. Today we would concentrate on the financial instruments, which is one of the important component of the Indian financial system. The financial instruments are documents issued by the organization receiving money. And for example, we can give a simple example of bank deposits. When we go to bank, deposit our money, bank issues a receipt. When we deposit money in the form of fixed deposit, bank issues a fixed deposit receipt. When we buy shares in a company, they issue a share certificate. When we buy a debenture, they issue a debenture certificates. So, in very brief, financial instruments are documents which are issued by the organization receiving money for the satisfaction of the person who is investing money in various types of investments. Now, the types of financial instruments, I would like to very briefly tell that we can classify the financial instruments into two parts. One are marketable, others are on the basis of market. Now, in the marketability, we can also classify these financial instruments into two parts. One are marketable and other are non-marketable. Marketable are those which can be easily marketed in the market and liquidity can be arranged. For example, these are shares, debentures, commercial paper, commercial deposit, etc. Whenever we need money, whenever the investor need money, he can go to the market and immediately sell them and can get ready cash available. Then there are other types of instruments which are non-marketable in nature. These cannot be transferred, immediately cannot be converted into cash. For example, bank deposits, NSC, LIC, etc. These are not in the nature of non-marketable. Now, another type of classification of these financial instruments are money market instruments and capital market instruments. Money market instruments are, for example, call money, treasury bill, commercial paper, certificated deposit, participation certificates, repo instruments, etc., etc. These are the money market instruments because their maturity period is not exceeding 1 year. They are generally for 1, 2 to 3 days or at the most 364 days, but in no case their maturity does not exceed more than 1 year. Then there are capital market instruments. These instruments are comparative for longer period. For example, there are shares, debentures, bonds, etc., mutual fund, etc. So these are for a longer period and their period generally is over 1 year, and that is why they are known as capital market instruments and they are for longer period investment. Now, under money market instrument, there are many types of instruments are available. For example, call money market, then treasury bills, then commercial paper, then certificate of deposits, then participation certificates, repo instruments, etc., etc. In this session, I would concentrate only in three: call money, treasury bill, and commercial paper. Now, call money market is a market in which a banker, whenever a banker needs money, it goes to the call money market. In fact, there is no market like call money market. Bankers go over phone to another banker who have a surplus money, and bankers generally need money to meet their CRR requirements, and at times they need money to invest to a customer who is prepared to take loan at a very higher rate. So in this call money market, a manager or a bank manager who needs money goes over phone to the another bank manager and request him for sparing some money. The entire transaction is over on the phone itself, and the rate of interest is decided on the basis of demand and supply. So in call money market, Money is being arranged by bankers to needy bankers, and needy bankers need money for maintaining CRR, which is required to be maintained with Reserve Bank of India, and secondly for advancing loan at a very higher rate. Now, for facilitating transactions in call money market, Government of India has also constituted an organization known as Discount Finance House of India. This organization facilitates transactions between banks. It has list of banks who have surplus on a particular day. It has a list of institutions which are in need of money. So through this, transactions are taking place in call money market, and this facilitates availability of money from those who have a surplus money, and it charges a nominal commission. So the entire transactions of call money market are being arranged nowadays through Discount Finance House of India. Another very important money market financial instrument is Treasury bill. These are the documents issued by Reserve Bank of India on behalf of Government of India. Whenever Government of India needs money for meeting its budgetary requirements, it approaches Reserve Bank of India, and on the basis of such request from Government of India, Reserve Bank of India is issuing Treasury bills. These bills are issued at discount, and the period of maturity differs. It may be for 91 days, it may be 182 days, it may be for 364 days. Now, these Treasury bills are all issued for two types. One are known as ordinary. In case of ordinary, the purchasers are public as well as financial institutions. The others are ad hoc, where purchaser is only Reserve Bank of India. So these two types of Treasury bills are issued by Reserve Bank of India. Now, there are many advantages of these Treasury bills. One first advantage is they are very safe. They are safe in the sense because the payment is to be made at maturity by the Reserve Bank of India. The another thing is it is very good instrument for maintaining liquidity, because these can be immediately transferred in the market and money can be arranged. And third is they are very good for making short-term investments, because they are ready cash, because payment is to be made by Reserve Bank of India, so nobody have any hitch in investing money in Treasury bills. There are few advantages also, and one basic advantage is, since it is a Government of India bond, since it is issued by Reserve Bank of India, highly safe, highly flexible, the yield is normally low as compared to other financial instruments. And the another disadvantage is, at times competitive bids are not available, because these are issued on the basis of bids invited by Reserve Bank of India whenever these Treasury bills are issued. So though these are very nominal, but there are advantages are many. I once again repeat that these instruments are very safe, very liquid, and they are very good for meeting short-term financial needs. Another instrument of money market is very popular is commercial paper. These are unsecured promissory notes issued for a fixed maturity. They are negotiable and issued in the bearer form at a discount. Always they are issued for discount. For example, there is a instrument say for 5 lakhs rupees, it might be issued for 4,75,000. Maturity may be in the 182 days or 364 days, depending upon the maturity period, the amount of discount is being decided. So they are always issued at a discount. Maturity period ranges from 7 to 364 days, and minimum amount of rupees 5 lakh is there, and they can be issued in the multiples of 5 lakh rupees. They are issued by public institutions, private institutions, and non-banking finance companies. Whenever they are in need of funds, these instruments are issued by them. They go for rating agencies, and once the instrument is rated by rating agencies, it gets an easy market and they are easily sold in the market. Now they have advantage, like they are very simple, no formalities required, they are just issued. Those investors who have surplus money can immediately invest money in these security. Their way of borrowing is very easy, no formalities, no documents are required, and the return on these instruments is comparatively very high as compared to Treasury bill, which is a very secured and safe instrument issued by Reserve Bank of India. These instruments are issued by, again I repeat, private organizations, public organizations, NBFCs, but all these institutions are reputed organizations. Only reputed organizations can issue these commercial papers. Though I would discuss only 3, remaining I would discuss that is financial instruments of money market. In the earlier session, I would recall that we discussed 3 types of financial instruments of money market, that is call money market, then treasury bill, and then commercial bill. I would now continue with 3 more instruments, and these 3 more instruments are: number 1 is certificate of deposit, number 5 is interbank participation certificates, and last is repo instruments. I would first of all discuss certificate of deposit. These are the promissory notes issued by scheduled commercial banks and reputed financial institutions. I would once again repeat, these certificates of deposits are issued by only scheduled commercial banks and other reputed financial institutions. In earlier lectures, I made it clear that scheduled commercial banks are those whose name has been included in the 2nd schedule of Reserve Bank of India Act. So besides scheduled commercial banks, these are also issued by reputed financial institutions. Under reputed financial institutions means those who have very strong financial position and also they are working in public sector. Now these instruments are issued in the form of promissory note. They are easily transferable, easily sellable in the market. They are issued at a discount and maturity period is always fixed. Minimum amount of this is 25 lakhs, and again they can be issued in the multiple of 25 lakhs. Period is 1 year. In case of commercial paper, the period was simply slightly lesser. RBI has permitted the Industrial Development Bank of India and Industrial Finance Corporation of India to issue such commercial deposits, certificate of deposits for a period of 3 years. I once again repeat, they are issued only for a period of 1 year, but as a special case, RBI has permitted good institutions like IDBI, Industrial Development Bank of India, and Industrial Finance Corporation of India to issue these certificates of deposits for a period of 3 years in an exceptional case. They have many advantages like commercial paper. They are very easy, very simple, and return is always high. The only disadvantage here is that some stamp duty is required, and because of that stamp duty, there are some problems in their issue. Now, I would also like to make these 2 common type of instruments. One is known as commercial paper, other is note certificate of deposit. There are few differences in both these 2. Now, the commercial paper and CD. Commercial papers are issued by companies, while CDs are issued by scheduled banks, and besides scheduled banks, 2 institutions as an exceptional case have also been permitted by Reserve Bank of India to issue CD for a period of 3 years. Now, in case of commercial paper, period is 7 to 364 days, while in case of CD, the minimum period is 1 year. Now, minimum amount in case of CP is 5 lakhs, but in case of CD, this minimum amount of issue is 25 lakhs. Now, in case of CP, no stamp duty is required, but in case of CD, some stamp duty is also required. Another difference is that in case of CP, they are rated by rating agencies to facilitate their early selling in the market, but in case of CD, no rating is required. So these are 2 common words, and mostly, particularly in examinations, instead of writing full name, that is commercial paper or certificate of deposit, at times in paper only 2 simple words are mentioned, CP and CD, and that is why I have made it very clear that what is the difference between CP and CD. Another type of instrument is interbank participation certificates. As the name says itself very clearly, these are the certificates issued by banks for meeting their credit requirements among themselves. So they are known as interbank participation certificates because banks participate in these certificates. In fact, Reserve Bank of India allowed issue of such certificate in the year 1988 to meet the credit needs of banks among themselves. Period is 91 days to 180 days and issued by scheduled commercial banks. As the name says, whenever a particular commercial bank need money, now they have not to go to public, they have to go to their sister colleague banks, and they go to them and request them to buy. So mutually they arrange money whenever they need money. And when money is required, earlier also I made it clear that at times banks money for meeting their CRR needs, which is required to be maintained with Reserve Bank of India, and presently the CRR is required to be maintained with Reserve Bank, and the rate of CRR, present rate is CRR is 4%. At times banks also need money for lending at higher rate. So this is a new instrument permitted by RBI in 1988 to arrange money by banks by taking help from other commercial banks. The last instrument in the series of money market instrument is the repo instruments, and issued by a promise to repurchase by after the fixed period. These are issued by the issuer with a clear promise that the issuer would repurchase them after a period of say 60 days, 90 days or 1 year. So the difference between the issue price and the final payment price is the money which the issuer loses and the purchaser gains. They are very common now, and they are issued with a promise to repurchase by a fixed period. So the investor is also sure that after a fixed period, that is 60 days or 90 days, the issuer would repurchase them. So they buy with a clear motive that they are going to get their money back. So these are in very brief. I once again repeat, there are 6 types of instruments of money market, starting from call money, then the treasury bill, then commercial paper, then there is a certificate of deposit, interbank participation certificates, and finally repo instruments. One of the feature of all these instruments is that they are for a short period, and short period is ranging from 2-3 days to 1 year, with the exception of the certificate of deposit. In case of exception institutions like IDBI and IFCI, they are permitted by RBI to issue for a period of 3 years. Otherwise, all these 6 types of instruments are issued for a short period ranging up to 1 year. Thank you, thank you, thank you.